Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, May 13th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. It's for informational purposes only. Please do your own due diligence and research. It's your money, it's your responsibility. Okay, so there were a few videos this week, interviews with Stan Druckenmiller, one of my favorite investment managers, pretty smart guy. And I'll put a link to this video, and then it's like 5 minutes, and then there's some follow-ons about some other subjects. But this is this particular video segment, which is about 5 minutes long, where he says that I'm sitting here staring in the face of the biggest and probably the broadest asset bubble. Forget that I've ever seen, but that I've ever studied. And so we've kind of talked about this. A lot of people are kind of, I mean, it's hard to fathom, right? Because you're trying to think relative to other times in history. And most of us are not as schooled up on financial history as Stan Druckenmiller and some of these other guys that are, been doing this for decades and have been very successful. But, he talks about how the Federal Reserve facilitated this, and then the federal government with the stimulus after the pandemic. We've just created this huge surge of liquidity and cash that, overinflated assets. And so we have this huge asset bubble. We now have the quickest raising cycle in the history of the Fed. Rates have been taken up to a little bit over 5% now. 5 to 5.25, whatever it is. And QT continues. Bank lending is tightening. And, we've already seen, like I said before, I use the analogy of a volcano that's getting ready to erupt. You have many, many indications pre-eruption, right? You have earthquakes, seismic events, small, smoke and, little bits of lava coming out of the top of a volcano, and all of a sudden the thing explodes and causes devastation. So that's kind of the analogy that I'm looking at. I think you have to understand now. I think that the Fed's just going to keep on this course. I don't think that they maybe raise rates anymore, but the QT will continue. And again, and of course, bank lending will continue to tighten because of the problems in the regional banks. One of the things that he discusses in one of the follow-on videos, talking about he being Stan Druckenmiller, is just how much of commercial real estate debt is stuffed into these regional banks. They are major facilitators. This is what they do, right? They're in their little regions or areas of the country. They know the markets. They, make loans for these things. And now, we're going to start seeing this stuff blow up. Why? Because things are not returning to the way they were pre-pandemic as far as people coming back to the office. Now, some people are coming back. People are realizing that face-to-face meetings, actually, and having interaction live is more collaborative, but again, a lot of the workforce, a lot of people that I know are making it a condition of their employment that they, especially like knowledge type workers like engineers and stuff like that, they're refusing to go back to the office. They'll just say, well, I'll just take a job somewhere else where I don't have to go to the office. I can get on a Zoom call. I can review these drawings at my house, make my comments, and then review them with the team on a Zoom call. I don't need to commute into the office and sit in a cubicle all day to do this. So that's going to have an effect. What is going to be the ultimate effect? I don't know. The other thing that I'm going to mention, that I was talking to someone about this, is that policy in a lot of these major metro areas inside these cities, if you will, these central business districts, whatever you want to call them, the downtown area, I don't want to say most of them, a lot of these cities are just turned into dumps. I mean, you have all kinds of homeless, drug abuse. I mean, you can point out the extremes like LA or San Francisco, or some of the nonsense that's going on in New York that you see on Twitter. And, some people that live in these places, they will pass it off and say, well, the advantages of living in New York City far outweigh, being pushed into the front of a subway train in the subway by a mentally ill, drug abuser. I don't look at it that way. These places are dumps. The policies are being pursued to continue in that way. I'm not going to get into the recent court case that's now going to happen in New York, where the guy choked out another guy in the subway. But, this is what you're seeing. And so people are like moving away from this. We're seeing, the facts are that people are moving from high tax, high regulatory, dumpy places to places, that have low taxes, lower regulation, and have higher quality living standards. And so that means that, that's something that has to be factored in, but nobody wants to talk about. So these regional banks, that I'm getting off track a little bit, but that's not resolved yet, in my view. The commercial real estate situation's not resolved yet. Now that the economy is definitely turning down into recession, I mean, I have completed building at least the basics of my Nowcasting model, and everything that I'm looking at, which I'll get into a little bit later, is negative. Okay, I'm not, and this is all publicly available data that you can get from the St. Louis Fed website. They call it FRED. They collect all this economic data. Everything that I'm looking at is negative. And trying to recreate the proprietary hope cycle situation that Piper Standler has created in myself, I kind of like that. I've listened to about every podcast I can listen to that this guy was on. And I think I've been able to recreate it. And it's amazing when you look at the statistics, how as tightening liquidity and credit works its way through the economy and, affects things. Now the final straw to break the camel's back of the economy and push us into recession. Now we're starting to see employment come under, strain. Initial claims are starting to go up. Continuing claims are going up. And so we'll see. Some commentators, some forecasters, other people I respect are saying, well, this is a bifurcated economy. Yes, housing and manufacturing seem to be in recession, but the service sector is booming. People are still going out to dinner. People are traveling. I don't doubt that. But as unemployment begins now to tick up, that's going to cause people to pull back. So I think, again, don't forget the lag effect of the previous tightening that's happened over the last year. It doesn't just affect the economy instantaneously. It's a lag effect that has to work its way through the economy. And so I think that as time goes on, as we get deeper into the summer and into the early fall, it's going to become apparent that that's where we're at. So again, even I'm looking at my liquidity indicators. I mean, there's websites that track central banks. Most of the world's still in tightening cycles. Okay. So this doesn't bode well. I mean, eventually the worm will turn, but right now things do not bode well. And again, I don't try to forecast. I don't know what will happen in the future. I'm just trying to look at what's the current situation look like? Okay. And what's the trends? The trends are all negative, just about in every category that I was looking at. I mean, there was a small little uptick in housing recently, but I'm not going to say that has turned. So, at least in housing starts. So I think that, we're looking at definitely rig for heavy weather, like I've said before, as we sail into some heavy seas coming up. This is an excellent, video, 5-minute video, but we've talked about this before. But I think putting some context around this is, what does that mean when you say it's the biggest and broadest asset bubble? Well, then reversion to the mean means what? A lot of pain. And so here was a tweet by a guy. He's quoting Stan Druckenmiller. It says, this is part of that whole Sohn conference that he was interviewed at. This is another quote. It says, Volcker This is from Druckenmiller. Volcker intentionally threw us into a recession. We had a horrible recession in 1982. Big increase in unemployment. But you know what? Reagan won 41 from 9 states in 84. We got 20 to 30 years of prosperity. We took the pain and we cleaned up our act. This partially is accurate. I mean, there's no way that Reagan could win 49 states again now because the demography of the country has changed significantly. I don't necessarily just attribute the prosperity that we saw in the 80s and 90s solely to crushing inflation and lowering rates. That was a big tailwind, but there was a significant amount of deregulation during those times, and that helped to increase productivity, to loosen up the economy, to make things more efficient. So I guess the point I'm trying to make is, if Paul Volcker was the Fed chairman now, with everything so politicized as it is, with the debts where they are. Another thing that's different now is the federal, state, local, all the debt situation in this country is tremendously, exponentially worse than it was back then. Okay, so if you wanted to raise rates, keep raising rates, and definitely throw the economy into a recession, it would just explode the fiscal situation for the United States government. I saw the recent chart. I didn't put it up this week, but I saw the update. Somebody had it on Twitter. You can track this at the Fed website, also St. Louis Fed website. But the interest on the debt now, with as these interest rates percolate through the economy, this rate raising, and as the Treasury has to roll debt, interest payments now on the federal debt are closing in on $1 trillion, or like 900 and change billion dollars, right? So, and that's, if you look at the chart, it's going up at about a 75% angle. It's almost vertical. So the odds that this can continue for much longer without major catastrophic breakages somewhere are just not. It's just not going to happen. So I think that at some point, things, again, it's part of that whole volcano analogy. We just don't know when it's going to blow. But the tremors, we're sitting here in the village, and the tremors, it's, I guess if you were in that situation, you would probably want to leave, right? You wouldn't want to stick around and, wait for the big one. That's the point I'm trying to make. And so here's more from Druckenmiller. Another thing he talks about is in this conference, and I'll show another chart after this, is entitlements and the looming disaster that the United States fiscally is going to face vis-a-vis entitlements, which I wrote about probably over 5 or 6 years ago on my blog, where I suggested that entitlement spending in the United States, I aped onto the Blue Oyster Cult lyrics of their song, Don't Fear the Reaper, another 10,000 coming every day. It's talking about people dying, reaper harvesting. I'm talking about 10,000 people a day in the U.S. going on, Social Security and Medicare every day. And that's basically what happens as the baby boomers age out. The next, we have this skewed towards all this huge cohort of retirees, and we don't have the money to support them, yet we've made promises. And so what Druckenmiller says here, quote, all this focus on the debt ceiling instead of the future physical issue is like sitting on the beach at Santa Monica worrying about whether a 30-foot wave will damage the pier when there's a 200-foot tsunami just 10 miles out. This was an email, I guess, that he sent to Bloomberg. And, then we talk about, we show these things. Whenever I see these, I bring these up because I am interested in this. This is where we're at today. This shows you the entitlement spending that's on an continuous growth higher. Says the demographic storm is just getting underway. We are already spending almost 40% of all taxes on seniors. In 20 years, entitlements will cover 60% of all taxes. So, if you listen to people like Newt Gingrich and some of these other Republicans, well, we can grow our way out of this. We need to, their answer is we have to grow the economy. We need to cut taxes. We need to stimulate the economy. The economy, if it grows sufficiently, we can outgrow this. But that's just going to not happen in the current political climate because of the bipolar nature of the two parties are totally opposed to each other. Yes, the rhinos, the make-believe conservatives, want tax cuts. They want to cut back on entitlements and spending, which I agree with, but they don't really want to cut spending. You see what I'm saying? So it's just not politically going to work. We are past the tipping point where, again, as I've said before, you need to prepare yourself. I mean, is this actionable? Not today, because this is, again, some point, this doesn't matter until the day that it matters. And you can't really forecast that, but you need to have it in the back of your mind, because what's going to be the solution? They're not going to rein in entitlements. They're not going to cut benefits. The cohorts are so large that these people actually vote. Okay. And they have it in their mind that they paid into these things and they're entitled to them. That's why they call them entitlements. There are court cases, though, that the Supreme Court already ruled on this, and I pointed this out in my article, and most people don't know this. You can talk to any of your old relatives, your parents, aunts, uncles, and they will tell you all the same thing. I paid into, it's not like an annuity or a investment 401k. It's already been ruled on in the 50s that this is basically a welfare program. It's a wealth transfer program, and it's subject to the whims of the legislature, to the Congress, to change it at any time. And the reason why was to explain this for people that I've talked about this before, but a quick aside, there was a court case. I don't remember off the top of my head. You can look it up. But basically during the 50s, when we had the Red Scare here during the Cold War, there was a guy, I think, that was from Bulgaria. He had been in the United States for like, I don't know, 10 or 15 years. He had been working, he had been paying into Social Security. He got deported, I think, for being a communist sympathizer or spy. I don't know. He wasn't a spy, but he was like agitating for communism. And so his argument was that because he had paid into, he was denied benefits, I think. So I'm just trying to do this from memory. But long story short, the Supreme Court ruled on this. It got to the court and they said, doesn't matter that you paid into this. It's not, they ruled that it's not an entitlement, it's not an annuity. It's basically a transfer payment, and it's subject to the whims of the legislature. So that most people don't know that. And of course, the Social Security Administration has this on their website. You used to be able to, I need to check on that, but they used to have this, wasn't like on the first page, but it was there. It explained that it's not an annuity. It's not an investment program. It's basically a wealth transfer, and it can change at any time. As it recently, they hiked the benefit because of the inflation that we had in the last year. So if this is all you have, then you're condemning yourself to a life of poverty. If this is all you have for your retirement, that's why you have to save. That's why you have to invest. That's why you have to be schooled up on this. And because of the situation in the West now, the decline, and because of the thievery, the skullduggery, the double dealing by politicians, and this technocratic class, financialized economy, you can't just put 288 a payday anymore into a index fund and count on compounding. You have to be schooled up. You have to be active. You have to have some understanding of what's going on in your investments, because if you don't, you're going to condemn yourself to the whims of the Congress, and they don't have the money to pay these entitlements. It's just a math problem, okay? And the situation will be that they won't cut them, but as Bernanke told, not Bernanke, but Alan Greenspan told Ron Paul when he asked him about this in a congressional hearing, Chairman, the maestro, Mr. Greenspan, said that the United States has this thing called a printing press. So we will be able to print the money to pay the benefits, but of course, Ron Paul's not an idiot. He's an Austrian economist, so he knows what the next question to ask is well, what about the value of those dollars? And Alan Greenspan said, I won't guarantee the value of the dollars, but we will pay the benefit. So that's what they will do. If you look throughout history, what you can anticipate over the next 25 years of your life here in the United States, if you have any kind of wealth, is higher taxes. We're probably going to be looking at a consumption tax, a VAT tax, like in Europe. You can be looking at more of these stupid regulations, like I pointed out last week, where if you have a higher credit rating and you put a higher down payment down, you pay higher fees on the mortgage, because that'll be part of, they'll couch that under diversity, equity, and inclusion. You will definitely have more inflation because they'll just print the money and pay for this. And so, you have to think about diversifying yourself into other things that can protect you. Eventually, if we have a physical crisis at some point, and I'm not saying the next year, the politicians will resort to what other uh, despotic, frontier market, emerging market type things like, capital controls. So my suggestion is if you have $5,000 in your 401k or a checking account, this isn't going to affect you. You're just riding along. If you have any kind of wealth, you can't be just wedded to the United States at this point. If you do, I think if you are, I think that is very short-sighted. But again, I'm not a financial advisor, but you can see what's happening. This is a long-term, you know, this is like somebody that's, an alcoholic in their 20s or smoking in their 20s. And, it's not going to immediately kill them, but the damage is cumulative. And eventually it gets to a point where, the system, the body doesn't work anymore and the person succumbs to this. And this is exactly what's going to happen. That's the nature of empires. That's what's happened throughout history. Every empire basically gets itself in the same problems. Rome, Greece, Byzantine Empire, Austro-Hungarian, all of them, Russian Empire, all of them, Spanish. Look at the history. They fall into the same thing. They want to expand. They want to be the hegemon. They want to, their military, the cost becomes too large, and it's always turns into a, basically desecration of the currency. So again, it's not actionable today like it's going to happen next week and you need to go do something. But I wrote that same article 5 or 6 years ago and nothing's really changed. There's not going to be entitlement reform. They're just going to print the money. And so what's going to happen when that happens? Well, the currency will go down in value. So you have to be thinking about protecting yourself against that. That's why having a position in precious metals, in my view, is important, because it protects you. I don't say these things to be provocative or like try to be funny, because people write me and say, oh, it's kind of, I chuckled when you said this. This is true. Gold and silver in your possession protect you against government and central bank malfeasance. And people go, what are you talking about? Come on, John. No, I'm just telling you. You have fire insurance, you have automobile insurance, you should have your financial well-being insurance. And that's what gold and precious metals do for you. All right, kind of got distracted a little bit. Let's get back on track. So more evidence of the upcoming recession, highest probability of U.S. recession predicted by Treasury spreads. Again, it's this pattern recognition 101. You look back at the shaded areas, going back, these are indicating recessions. You look at the Treasury spreads and you see where we are. And every time we've been at this level or higher, we have a recession. So the recession is going to happen. I think we're not arguing about that anymore. It's going to happen. Everybody acknowledges that now. And I think people now are still on the, well, it's going to be a soft landing tip. No, it's not. I listened to an interesting, I don't know, typically like on the great financial crisis, we had to have like some kind of major blow up to cause a catalyst, which it was, those banks blowing up and things like that. We haven't seen that yet, but that doesn't mean it won't happen. So yes, I think we're moving into a recession. We haven't seen anything hasn't really exploded yet to cause another GFC, if you will, a financial crisis. But that doesn't mean we can't still have a protracted and deep recession. That's kind of on the track we're on, because this economy just can't survive at 5% Fed funds rate. It just doesn't work. This is a credit-based consumer economy that only works at zero interest rates, basically, with QE. I'm sorry to say that, but that's it. And we will not, going back to this other slide, we will not take the pain. We're not going to have a severe recession and clean out all the malinvestment, let a bunch of banks, let a bunch of companies go bankrupt. Are you prepared to have 10, 12, 15% unemployment? For heaven's sakes, we got an election next year in 2024. You think that the Fed's not politicized or not aware of that? You don't think there'll be pressure from the Democratic Party? I mean, from all facets of Congress, it's not going to happen. Okay. The first time, that this thing starts to get out of control, the rates will be cut, and they'll be cut very quickly. That's what happens. And they won't be cut by 25 basis points. They'll cut them, a half point, 3/4 of a point, a full point, every meeting. If you look at previous cycles, that's what will happen. So, again, this is a debt-based economy. You need more and more debt now in order to have any economic growth, which is even smaller. We go back to I forget the two economists, Rogoff, and anyways, they wrote a book about this. I read it. This was like 10, 12 years ago, talking about when economies reach a certain level of debt, it just, keeps them from growing. Okay. And it's about 500 pages. So it's not an easy read, but to make it simple, call it the Japanification of the United States economy. Okay. Japan doesn't, is not poor and doesn't exist anymore. It's there. You can go there, but, it's not growing like it was, in the 80s when I was there. Okay. When it was boom times. The same thing will happen to the US. It's just going to be very slow growth or no growth, with a lot of problems. Okay. Which I don't want to get into, that are attributable that are self-inflicted. And that's going to be the future. And then you still have like all these other things we talked about: demographic, time bomb, entitlements, all these other things. So anyway, so this is where I think, the narrative has shifted from, okay, we're going to have a recession, but it's going to be mild. So we'll see. I mean, again, my data is all going in the wrong direction. It's heading for recession from my radar. That doesn't mean I can forecast. I'm not an economist. I'm not going to build models, but the nowcast, what's happening right now, is not positive, and everything's trending still negative. Here's another example. Box demand, this time about like cardboard boxes, down 8 to 13%. This is the three largest North American container board box producers reported box demand declines ranging from 8 to 13% in Q1, and demand has been consistently worse than they expected over the past 3 quarters. The third largest producer, Packaging Corp of America, reported a historically large 13% shipment decline in Q1. So that means less economic activity, less need for packaging and shipping. Though it did say on its call on April 20th that it had seen a, quote, big turnaround, quote, starting in April, with bookings in the first 13 days of the month 11% higher than those in March. So let me stop right here, because this is another thing that I pointed out in my newsletter last month when I was talking about my nowcasting formula that I'm developing. There's two things you really need to keep in mind, which I've mentioned earlier in this call, and I'll mention again. The lag effect of the rates and the tightening. Okay, you have to keep that in mind. The other thing you need to keep in mind when you're looking at these things is economic data is not linear. Okay, so you have to look at the trend over a period of time, or like even a moving average or things like that, because this is what can happen, right? You can say, okay, well, overall, it doesn't look positive, but yet we had a big turnaround starting in April. But is it sustainable? It very well could be that there's a turnaround and we're going to have, the economies, maybe we are going to have a soft landing. Maybe there was an inventory situation and now we have to rebuild inventories. But what's the overall trend? Is it still okay? You had this uptick, so you can look at economic data, the history of it, and even in the context of a decline, you will see upticks. It's not linear. Keep that in mind, because this is what the mistake that I see a lot of analysts making, or I wonder why they make it. And they'll say, yeah, they'll be on these Twitter spaces, which are very interesting. You have very smart people, and they'll say, yeah, but what about this data point? Well, you can't hang everything on one data point or 1 month's data. You say, okay, well, if it happens over 2 or 3 or 4 months that it's turning around, then we really got to look at it and say, this could be the beginning of something. It's the same thing. If you look at the housing data, I have it kind of not red I made like a stoplight KPI chart, where if things are positive, you get green, kind of in the middle, yellow, or it's kind of ambiguous yellow. And then if it's in decline, red. Well, housing, you've had an uptick recently in housing starts and stuff like that, but it's still in the context of an overall downtrend. Okay. And so that's why you have to look at it. And that's why I put it kind of yellow. are things turn around? You do have those demographic pressures of that cohort of millennials wanting to start families, and I know people want to argue with me about that, but people are the same. You have a very large cohort of people now are entering the stage where they want to start families, and people want houses. And some people have said I've listened to the people that argue against that there's plenty of houses, but I'm not sure there are, but where do you want to live? There's plenty of houses inside the city limits of Detroit that are for sale, but nobody wants to live there. I mean, that's an extreme example, I know, but where do you really want to live? People don't want to live in these crappy cities. People don't want to live in these high tax areas, so they're moving to Tennessee, Florida, South Carolina, Texas, yada yada, Nevada, not yada, Idaho, and there's a shortage of housing in those areas. So you have to look at things in context. So it goes on, it says, we mentioned this uptick, and then it says 2 weeks later, the Tri-City Herald reported that Packaging Corp is indefinitely idling. So this is the same company that said they saw an uptick, but now they're indefinitely idling one of its 7 containerboard mills that produce about 1,800 tons of paper a day, a decision that will result in hundreds of layoffs. So this was from the FreightWaves website, very good website. You can get a lot of data there. I got all these different sources that I look at, but all the things that I made from my Nowcast tool, basically it's all from the St. Louis Fed or the Institute of Supply Chain Management to get the PMIs and things like that. All this data is pretty much freely available. And then you have these little sub data points like this. So yeah, interesting. I didn't go to the Zero Hedge article, look at this, but California's Newsom sees $32 billion budget deficit in 2023 and 2024. Probably needs some more investigation. Yeah, the free money, it's the stimulus money, the abatements, all that stuff has dried up now. And, now, California relies a lot for its tax revenue on the wealthy people, their venture capitalists, and wealthy people with their stock gains and stuff like that. And let me tell you something, venture capital right now, everything's getting nuked. I do some angel investing, and I can tell you, I had a company that I really thought was doing very well, and all the reports are good, and everything is turned on a dime in 2 quarters. And what they do is they help other companies get funding, get in front of VCs, prepare founders for, coaching them up, and they get paid to do this, and they take warrants and everything, and the company got pushed into bankruptcy. And it's like, well, wait a minute. The last quarter report was positive, and now we're in Chapter 7 liquidation. So things have changed quite a bit, and that's because of a manifestation of the liquidity is moved away from these higher risk situations. And so consequently, you're not going to see, all these people getting, these big paydays as they take these, how many food delivery services do you need? They all can't be billion-dollar valuations. Okay. And when you cash them out, then you have big capital gains, and California relied on a lot of that. That wasn't the only thing, but they are the 7th largest economy in the world just by themselves. But this isn't positive. And this guy, Newsom, wants to be president. So we'll see. So again, oil prices weak. And, I know I've been moving from where I was a little bit bullish to more neutral on oil prices. It's confounding me because, obviously the economy is weakening around the world, but there are other areas like India and these other places that are doing well. And it's like, okay, at some point, it's like one of my acquaintances told me, you have to respect price at some point. Something's happening. You can't just, what are you going to say, that make excuses all the way down to $45 a barrel? I'm not saying we're going to go to $45 a barrel, but, I want to dig down. It's like, why is the oil price, as we came back, again, we have all of these things working to create an oil price. And like I said before, it doesn't take much of a surplus or deficit to have big price swings. We knew there would be volatility, but so it's like, okay, is demand really going away? because of the upcoming economic weakness? Is supply where it needs to be? Is China really recovering? Demand coming back? So all of these plates in the air. So, but again, the price is the price, right? Again, that's another part of it is liquidity. Most, eventually in a short and medium term, I've said before, sentiment and liquidity drives the market. Even in like oil, there's paper contracts that drive everything. Algorithms trade these. So if you get a bad economic print, oil sells off, right? Because that's what the algos do. And then it creates a situation where the price drops sufficiently, people pile on as shorts. So, but in the end, fundamentals went out. And so I'm not out here just trying to look for, fundamentals that support a bias. I'm just trying to look at as many data points as I can, say what's really going on in this energy market. The Russians haven't really cut. They've been exporting a lot of oil. Chinese demand has came back pretty good, but not to the point that we thought it would. We are facing economic contraction in the U.S., but I'm going to need to go back and look at previous recessions and see how much was actual demand affected. They just assume that energy demand goes down. Well, most people, even in a recession, still have their job and have to go to work every day. So, there's still people consuming, even though consumption goes down, and truck traffic may go down, but it doesn't collapse by 50%. I mean, again, the lesson learned is the pandemic. Even with the whole world locked down, oil demand only dropped to from 100 to 80 million barrels a day. I mean, I was shocked actually about how inculcated demand is. And as soon as, we let off on, everything started returning. So anyways, I wanted to point this out. This is U.S. gasoline inventories for the last couple of years. You see this gray area is the 5-year data or range. And you see that, right now, U.S. gasoline inventories are the tightest ever. This was a Bank of America research, but they said in the note that this was the tightest that U.S. gasoline inventories had ever been for this time of year. So, is that because, that's even with turnaround season over and now refineries shifting towards producing gasoline for the summer driving season, for people go on vacations and things like that. So this is, to my mind, bullish because in order to meet the demand, we'll likely have to have higher refinery runs, more importation of gasoline, whatever. So this is interesting. And so this was the road congestion index. This is from Bloomberg. This is off a tweet. This is indexed to the 2019 daily average congestion, which was the pandemic. So you say, where are we at pre-pandemic? You say this line right here, and you see that, we're not much lower. We're trending up towards that, right? We're still below the pre-pandemic, but we're rebounding. And so demand isn't really dropping off. This was the lockdowns. You saw what happened, right? When we locked down, I mean, demand collapsed, but, it started coming back. And so, we'll see. Demand isn't really falling off like people think, right, yet. So again, I need to go back and do some work on previous recessions and look at the data and see, well, how much did demand really fall off so we can have an expectation. I think I'm going to, what I've seen just anecdotally is it doesn't fall off as much as people think. I mean, a lot of the demand, I was actually shocked. I read a note one time that just from house building with all the contractors running around, things like that was a lot of the demand. That's why you would see even in the spring and summer would go up, demand would go up as the winter lifted and people started back in the construction season. But again, I need to take a look at it. And again, you just can't be focused just on the U.S. This is a worldwide market. Oil is pretty much fungible. Now, there's different grades, but you get my point. It's a worldwide market. And just because the U.S. goes into recession and demand drops by a couple percent, well, what's happening in India, Indonesia, all these other places, right, where demand is going up? What's happening in Africa? So this all has a tendency to balance out. Again, sentiment, though, is negative because we're going to go into a recession. So, people sell it off. They just assume. So again, you have to respect price. But what's driving that, you know? So another thing that happened that I got this from, there's a thing called Energy Tidbits that comes out. It's by SAP Group, something like that. You can get on this free mailing list. The guys on Twitter, I'll put a link to it. And they send out this weekly report about the energy markets called Energy Tidbits. And you have these like things like this that you don't normally see. It's free, by the way, for now. And I mean, it's invaluable for me. It's where I get a lot of my information, a lot of things that you normally don't see. And one of the things that happened in the last 3 months that I think has weighed on this, in addition to weighed on supply, giving more supply into the market. Not only the Russians, maintaining their exports, not really showing signs of cutting, but Iran evidently sold basically 100 million barrels of floating storage in the last 3 months. So again, that in the interim can put us into a surplus of supply and force the price down. So this is just a blurb from that note. It says Iran this is from a guy that's based in Iran. His name's Daniel Rahmat. He was on a podcast and they quoted him. It said, Iran during the last 3 months decided to sell most of its oil with remarkable discounts, talking about floating storage, because it was not making sense to keep that oil floating because the prices were getting better and better. So you were there to sell your oil with a discount instead of keeping that floating, accepting the risk, and also spending the money for keeping that floating. So you have this stuff stored on tankers and you're paying the daily rates for the tankers, right? Because you have an assumption maybe you'll be able to sell it for more later, whatever. So anyways, long story short, they sold most of this oil, and there is almost no gas condensate floating right now either. So, summation here is that Iran has reportedly sold all of their 100 million barrels of floating oil and undisclosed million barrels of condensate over the past few months. So that's, that is not going to help the price of oil because, you oversupply the market. You don't need to oversupply the market by millions and millions of barrels. It only takes, a 500,000 or 1 million barrels either way to cause a tremendous amount of price changes. So we'll see how much of an effect this had. We've had the OPEC cuts. One person that I respect has said that, it's not positive, guys, that OPEC is cutting supply. They're cutting it because the market is weak. So we'll see. Again, a lot of data points. Again, price is weak. It's under a lot of pressure. It's not looking good. And if we go into a recession, do we see a move down into the 60s, the 50s, the 40s? I mean, it depends how bad economic, in the end, though, as I look past that for the rest of the decade, I can see a situation where we're going to have record high. I still believe that the underinvestment is going to cause a spike. Now people say, well, what good does that do me now? Well, then each person, though, has to make an individual decision on what they think is going to happen. And so, do you sell and then try to buy back later? What's the bottom? When do you get back in? I mean, these are part of the things that you need to think about. And I'm not good at trading. That's my problem. And so I'm not helpful in that discussion. So I wanted to talk about tankers. I'm really bullish on tankers. No one really talks about it. There's a few guys on Twitter. Tankers are in a basically secular bull market in my mind. It's another typical supply-demand situation. Obviously, the stocks have been weak because the overall stock market's been weak. But I wanted to show this time of year, tanker rates have a tendency to be weak. This is a seasonality of tanker spot rates since 1990. And you can see like from June to July, August, September, until we get to October, we're kind of in a, weak period for the year. And then as we head towards the winter, we have this spike. So again, I'm looking at these things longer term. And if you look at the results of a lot of the tanker companies, I think a lot of the companies now are getting close to being fully valued, if you will. We bought these things a while ago, so got some pretty decent profits. But what's happening is excessive cash flows, which are being, people are paying down debt. Dividends are being paid. and increased in many cases, and stock buybacks. So I'm not saying it's time to get into these. It's probably past that opportunity to do that. But just wanted to point that out if you're interested in the tanker market. So here was an article in the Telegraph. I call it a stealth pro-nuclear article. I put a link to the article in the show notes. It says here a couple snippets. Many governments in the Western world have committed to net zero emissions of carbon in their near future. The US and UK both say they will deliver by 2050. It's widely believed that wind and solar power can achieve this. This belief has led the US and British governments, among others, to promote and heavily subsidize wind and solar. Not only that, it's a grift. Let's be honest, okay? There's a lot of money out there. Maybe politicians actually believe this. I think that, it's like any other industry. It's the current zeitgeist. People have committed to it because they think it's the answer, because they don't want to look at nuclear right now for different. But in the end, the gist of this is all roads lead to nuclear power, because this isn't going to work. But there's going to be hundreds of billions of dollars spent, and that's why we say heads we win, tails we win more. They're going to try it, no matter what I say on this podcast or what I think or what you think. And so you have to look at it and say, how do I take advantage of it? Again, find the premise that is incorrect and then position yourself to take advantage of that. So it goes on here. These plans have a single fatal flaw. They are reliant on the pipe dream that there is some affordable way to store surplus electricity at scale. Only one thing can save the day for renewables: reasonable cost, large-scale energy storage. Sufficient to keep the lights on for several days at a minimum would solve the problem. There is one So the problem is, they go through the math on this. These are math problems. They're not, I want to believe and I care and it's just going to happen because it needs to happen. And, we have to do something. It's a math problem. You need a certain amount with the current technologies. You need a certain amount of materials to do this. These cost this much. And if you run the costs, it's in the tens of trillions of dollars. I put the video up last week when Senator Kennedy from Louisiana was grilling one of the Department of Energy officials. He didn't want to say the real cost because he knows that when people look at it, they're shocked. $50 trillion is what some estimates are to get to net zero just in the US by 2050. It isn't going to happen, but they're going to try. It won't work. And then when there are no other choices, then they will flip to nuclear. And that's happening. That mindset's changing. And that's why I put these articles up here, because they're not one-offs. You're seeing more and more of these. And then eventually, after they go through all the math of why it won't work, it can't work, barring some miraculous change in battery chemistry, which I don't see, the final conclusion is there is one technology that can provide a cheap and reliable supply of low emission electricity: nuclear power. So again, all roads lead to nuclear power. This is an article from Reason magazine, something similar. And again, more math, talking about things they go into. Basically this is the article title: Nuclear Power is Humanity's Greenest Energy Option. It says, turning to the IEA's net zero roadmap, the team calculates that the amount of land occupied by the stunted trajectory of nuclear power plants would expand from 403 square kilometers to 820 square kilometers in 2050. The area devoted to growing biomass for energy production, that's for liquid and solid fuels, expands from 653 square kilometers to 2,900,000. I mean, this isn't going to happen. I mean, you're going to start encroaching on the ability to grow sufficient food. It's not going to happen. So it says, goes on here, a six-fold increase will occur in the spatial extent of power generation from approximately 0.5% of land areas used for electric generation in 2020 to nearly 3% of land in 2050. This assumes if you keep on this renewable tip. The world will be electrified by requiring an area roughly equal to the entire European Union, which is 1.5 times the size of India. The major contributor to increasing land use will be related to power generation from biomass. It's not going to happen. So again, they'll continue on this path until it's obvious, and then I don't know if that takes a year, 3 years, 5 years, 10 years, 25 years, but right now there is a lot of money flowing into renewables. It's not going to get turned off. It's stuff's going to get built, and again, the minerals don't exist to do it, and so that's where the opportunity is. Again, you have to get past this probably cyclical downturn that we're looking at over the next 6 to 18 months, and then after that, throughout the rest of the decade, I think you're going to be looking at a really excellent opportunity, especially with things like copper. So this is just a headline I pulled off. I didn't read the article because I'm not going to pay to subscribe to Bloomberg, but you get the gist. Blackouts loom for most of U.S. in extreme summer heat scenario. North American grid overseers warning is more dire than 2022. Aging electricity networks, increasing risks of power failures. So again, you could have a tremendous boom of investment led by the government, having a public-private partnership to, upgrade the electrical infrastructure of the United States. But we have other priorities, we have to spend $100 billion fighting for 2 provinces in eastern Ukraine that no one can find on a map. We need to prepare for some kind of war with China over Taiwan. We need to, have a $890 billion a year defense budget for what I don't know. And in the meantime, all of our cities are dumps, and we're going to have to go through blackouts because we have aging electricity infrastructure and nobody wants to do anything about it. Okay. And the U.S. #1. Okay. Keep believing that. See, this is the problem that a lot of people don't look at as part of this dollar hegemon thing that I take into consideration. I call these intangibles. Okay. The U.S. is a Potemkin village. You first look at it in the statistics, you say, oh, look at all this innovation. Look at what we do. Everybody wants to come here, but it's a dump. Okay. It's in decline. Okay. Not everywhere, not every neighborhood. Somebody's going to say, well, what are you talking about? You're always doing that. Go into these cities. Look at the physical situation. Look at stuff like this. Okay. I mean, look at the border. Look at the fentanyl crisis. Look at all the people living in tents. Look at all this stuff in totality. Okay. People aren't going to like this. I go to Russia. Well, I used to go. People don't live in tents in the cities. Okay. There's not crazy people roaming the subways, threatening to assault people. Things are relatively clean. Yeah, you can go to the villages and there's problems there. Every country has its problems. Okay. I'm not saying it's on the upswing, but the cities are a little bit different. And I don't, again, you can't compare Florida and New York or Tennessee. I mean, people are moving to places, but even that's going to run out. I mean, if you bring in millions and millions of refugees from all of these poor countries, what do you end up with? I mean, do we have the ability to support them? What's it going to do? I mean, we have a lot of problems here. And so we put up this facade on the outside and everything looks shiny and wonderful, but things like this are a big deal. I mean, how are you going to have a 2050 net zero with an aging electrical infrastructure? It doesn't match. Reality with aspirations don't match. And I guess I could go through and make a spreadsheet, like all the things that are like, this is what's claimed, and then this is the reality. But that's just my perception. It's just, a lot of this is anecdotal, but I just, talking about this entitlement, these entitlements need to be reformed. And people need to, but you're not going to get elected telling people that, you paid in hundreds of thousands of dollars into Social Security and Medicare, and the Congress is going to have to cut these things, and we're going to have to inflate the dollars, and you're going to become net poor. People don't want to hear that. Okay, because they've, convinced themselves, and they've been convinced that they don't have to take responsibility for their own care and when they're elderly or their retirement, because the government has Social Security and I paid into it and it's an annuity and I think it's a retirement plan or whatever people, it's like was it real Will Rogers? It's not what you don't know what gets you in trouble. It's what, you know, it's what you don't, it's what you think is true that isn't, is what gets you in problems. And so this is we'll see what happens. I don't know if this is a prediction, but this is a big problem. This is an ongoing discussion that the different ISO operators, your grid operators, have been saying for years, and no one's doing anything about it. Again, here's another Bloomberg article about copper. That's why I reiterate, heads we win, tails you win more. It's talking about the copper mine flashes warning of huge crisis for world supply. The transition to clean energy depends on copper, but a vast Mongolian mining project offers a glimpse of the metal's troubled future. Quote, there's no way we can supply the amount of copper in the next 10 years to drive the energy transition and carbon zero. It's not going to happen. And that was from the article. I don't have access to Bloomberg, but, we've been saying that. It's on Bloomberg now. So they're still going to try to have an energy transition regardless. We'll see what happens. Okay, guys, that's it for this week. Appreciate the support. Again, I'm not going to show my nowcasting formula thing that I'm continually refining. It's kind of fun trying to look at things and see how putting together my, what's going on currently in the economy. Again, I don't want to use it as a forecasting tool because it's kind of just showing you what the pulse is. But I'll be publishing that in the newsletter for the newsletter subscribers, and kind of showing them what I've got, my work, and hopefully we'll see if people have some suggestions to improve it or comments. I'll just talk in general about it on these on this because I put a lot of time into it, and I think it's actually pretty cool how it seems to work. So we'll see if it continues to work, how it works, add to it data points, subtract where necessary. But that'll be available for the newsletter subscribers. Okay, guys, that's it for this week. We'll talk to you next week. Thank you.